All right. So I have the one and only Jonathan Tink here. This is one of the best lenders in the area with Compass Mortgage. Also a dear friend, decent golfer, crappy hunter. No, that's not true. Were you just on a trip?
Yes.
Was that a work trip?
Which one?
I don't know. Weren't you hunting and fishing? That's what you guys do at Compass Mortgage.
I did some fishing. Yeah, we were in Florida and did my first ever fishing experience in the ocean, which was pretty cool.
Nice.
Yeah,
I caught a stingray by accident. My only time fishing in the ocean. It was quite an interesting thing.
I think you
So
can get
we
arrested for that.
I think so. We were trying to get all the different lines out, and it got caught and everything. It was a whole fiasco. But
Nice.
yeah, man. So I wanted to bring you on. There's been so many questions that we've received regarding mortgage rates. We've been in an environment for a few years now where they've been as low as they've ever been. Even where they stand today, just about 4%, that's historically low. But given that there was roughly a point increase over the last, I don't know, couple months, basically whenever word came out that the Fed was going to take rate hikes, mortgage rates moved on that news alone and have come up a little bit. So I wanted to go through and just get your take. And I know you're getting those same questions. And let's just go through some of the data and what you and I put together to share with everybody on this recording is just there was a similar point in history in 2018 where rates went up about a point and they actually climbed above 5%. And so I've been looking at that, and I can get your 2 cents on that. Of is that a fair thing to look at when trying to understand what's going to happen today in 2022, when rates have jumped a point? We're at a lower point than we were then, but I think it's still fair to look at, and just what the impact to housing prices were when that happened. So, you down for that today?
Yeah, yeah, absolutely. Let's do it.
Sweet. All right, so here we go. I think you can see that.
Yep.
This is a chart going back about 20 years of the 30-year fixed rate mortgage rates. And a couple things to point out here. You can see here 2018, it's actually November 2018, when rates peaked just under 5%, the average 30-year fixed rate. And again, that jumped up almost a point pretty quickly. And that's similar to what we're experiencing now. So that is the point that I wanted to look at to compare this with where we are today and what the impact on home prices were. Now, do you have a guess on what happened to home prices in this point in time, 2018?
Nope.
No guess, huh?
I want you to show us.
All right, I'll show you. So this is the same point in time, same corresponding chart, just with home prices on what happened in 2018 when rates jumped up to almost 5%. So tell me what you see here.
Nothing happened. They just kept going up as they should.
Exactly. Nothing happened. Nothing happened. Now, that's not to say that nothing will happen this time. We have some preliminary data that would suggest that nothing's happening. But It's interesting because I don't know. It obviously changes affordability a bit when your rate goes from 3 to 4. But in your experience, does that actually sideline some people? Like, how many people are you working with that when those rates went up the last couple of months truly dropped out of the housing market?
Nobody. I can't say that I've had anyone fully do that. I don't think you're going to see huge shifts in the buying demand just in that type of a shift of interest rate. If we saw this like double again and we go to 5 or 6%, we might have a different conversation. But I think we're seeing a big dip in the mortgage industry as a whole because nobody's refinancing anymore. We're losing that. But as a purchaser, as a first-time home buyer or downsizer or moving for a job, hey, we're planning on doing it, and it kind of stinks a little bit that your neighbor or your buddy or your family member got that 3% rate 6 months ago, and we're not seeing that anymore. But that's not gonna, I don't think, deter too many people to just say, okay, I guess I'm not gonna move anymore. There's too many other factors, I think, promoting that move. A lot of people are wanting to move because, hey, I'm going to get top dollar for my house because prices are high. Yeah, you got a little bit of a higher interest rate, but that doesn't deter you, I think, from continuing to move forward with that. I remember that 2018 very well. That was only my second full year in the business. And yeah, it got a little bit quiet because you're only looking at purchases, and the conversations change a little bit when you pre-approved at 4.25, and then when they go under contract, it's 4.75. You've got some explaining to do a little bit,
Sure.
but yeah, people still bought homes, and it continues to be a good investment. As you see that chart just keep going up.
Yeah, I'm with you. With all the volatility in the financial markets, and again, it's not that real estate can't go down or can't go sideways, but over the course of history, if you've held real estate for about 8 years or more, even after the Great Depression, you've been able to make a little bit of money on real estate. Obviously, if your time horizon is shorter than that, anything can happen. But I don't know when looking at this chart, if there's an asset class you'd rather be in, especially with high rates of inflation. It has historically kind of kept up with inflation pretty well, real estate that is. So yeah, it's interesting. I'm not seeing a whole lot of people sidelined either. I think the one people group that maybe it slows down a little bit are investors. And I think for the health of the market, that might not be the end of the world. You look at first-time home buyers being squeezed out and really having a tough time in this environment where supply is super low and investors are increasing their portfolio size. This makes the numbers a little bit tighter for somebody like that, but that again might not be the worst thing for the market. Or if you're a first-time home buyer, that might be something that you're looking forward to, is slowing down some of those investors. But all in all, we're still seeing a ton of demand, at least more demand than supply. And to your point, I think personally rates would have to do something drastic to slow the rate of appreciation that we're seeing. There would have to be a dramatic shift to go from a run rate of plus 10% appreciation to depreciation in home prices. So I think it could slow it a little bit, but I think it's still going to have demand greatly outpace supply. What are your thoughts on chasing a rate? Meaning, my thought process has always been that if rates were to go down, you always have the opportunity to refinance. But if they go up, you're kind of screwed, right? So to me, like, I've never understood the psychology of really trying to like chase or really hold out for a rate or really stress too much about that. Like, what are your, like, how do you counsel folks on that conversation?
Yeah, I always just kind of give the, speech about whether you're risk adverse or not, or what your risk tolerance is, because I try to give myself as an example. I'm quite risk adverse, and so if I had the opportunity to lock something today or risk it for a month and kind of see what rates do, I'm going to go ahead and just lock it most of the time. It's not. See if I can get this right. Like the pain of waiting and that rate going up, I think, is greater than like the little bit of like shucks, I should have waited because the rate went down an eighth. Like that pain, I think, is greater than that little bit of reward, in my opinion. So I would rather avoid that pain, take what you can get, be happy that as a historical context, especially right now, we're in amazing shape, and know that, hey, if it goes down in the future and we get something better, great.
Yeah, no, I love that. All right, so here we have a scenario to play out for folks. So this is comparing a 3% interest rate to a 4% interest rate. Can you take us through this and like what is the true impact of a rate going up a point on a house that's 350 in this scenario?
Yeah, so we just kind of wanted to show that just to give a little bit of reference, because in my world, in the mortgage world, we really are only working on that monthly payment. That's our world. And in the real estate world as a whole, what do you really talk about? You talk about purchase price, you talk about maybe interest rate, because of the mortgage. But it's always my job to help buyers, whittle that down from a purchase price, a down payment, interest rate, taxes, insurance, all those different things. What's the bottom line? And our bottom line is what we qualify for on a monthly basis. That's where you get the term debt to income ratio from. And that's what's really important. So we wanted to show this just to kind of give you a reference point of oh man, it's 4% or it's even higher and it should have been 3. I can't, I can't buy. That's terrible. Well, put it in this reference, and I honestly think some people might look at this and be like, wow, that's a huge jump. Maybe I don't want to buy anymore. And I think some people will look at it and be like, oh, that's not that big. I thought it'd be worse. I think you're going to
Yep.
find people in both camps.
Yep.
And I think I could kind of argue both sides as myself too.
Sure.
But just kind of giving you an example there of what that principal and interest does from 3% to 4% on that type of a purchase price, and what the monthly basis comes out to. And that's where it's kind of, a case by case situation, person by person, and what that does to you as a buyer. Does that make a big difference to you, within your budget? It might bump people out of their budget. They might have thought, 300 was where we wanted to be, and that's going to be great. Ooh, that little, $150 increase is more than we want. We have to back it down. Or, some people, oh, that's fine. That's still within my budget where I want to be, no big deal. So it's just going to be a case by case situation, but should give a little bit of helpful insight into what that rate increase really means from a monthly payment standpoint.
Yeah, no, that's good. I think, yeah, breaking it down to say, hey, this point's worth about $150 a month. To your point, I think half the people freak out. Half the people say that's just, that's one time going out to dinner. So I think
Yeah.
depending on who you are, you have a very different, view on whether this is still attainable to buy this house or not. But to your point, affordability for some folks maybe is challenged. Does it keep them out of the market? Probably not, at least from our experience. Are they going to go look for a house that's 325, or instead of buying the 4-bed, 2-bath, it's a 3-2? Probably. People still need a roof over their head. So again, I think it slows down some investors, but I don't think people searching for primary residence, at least with interest rates where they are, even above 4, are really slowed down by this at all. So.
Mm-hmm.
So here's I want to get your take on a few things. So these are some variables that I'm watching, that relate back to obviously housing and affordability and just what's going on in the markets. And wanted to get your thoughts. I'll kind of tell you the lens that I'm looking through, and just wanted to get your quick take on it. Is I'm watching inflation, not from the standpoint of, oh, housing tends to keep up with inflation, so what's that going to mean for housing? Because it's not a direct correlation. It tends to be true, where if inflation's running hot, then home prices tend to go up with that. But what I am looking at it from the frame of reference of just consumers' overall purchasing power. So if everything around us goes up, 20% here, 10% there, 5% here, does that blow somebody's budget? Meaning, do we actually free up inventory? And I don't love the way that this would play out as somebody not being able to afford what they thought they could. But does that cause some people to have to make purchase decisions or sell a house that they didn't think they thought they could afford but can't anymore if we run too hot for too long? Like, what are your thoughts on that?
Yeah, I mean, it has to. I was just having this conversation with kind of some friends the other day, and when you broaden the scope on that home purchase, okay, we looked at that calculator and it's $150 more a month. Okay, great. I can deal with it. No big deal. Or, maybe it's a little bit bigger, and maybe you went a little bit higher on a purchase price than you really wanted because the home was just perfect. And you rationalized it and you got over it and you bought it and you're happy. Everything else is going to continue to be added onto that. So if you broaden the scope, you think about some of the other miscellaneous items of home ownership that, kind of need to be taken into consideration. Your heating bill, your HVAC, the tax bills, the water bills, everything that goes with home ownership, from maintenance to some of those bill items, are going to be trending up that direction too. So not to like scare anyone, but it is important, I think, to have that in the back of your mind. From a mortgage perspective, we hit the main things: principal, interest, taxes, and insurance. But I love it when we get to, even dial in deeper with buyers. Are like, well, what about some of the other things? That heating bill, that water bill, the electricity, everything like that. Hey, that's really smart. Let's talk about that instead of just talking about, oh, what's the max I can qualify for? Last thing we want to do is make anyone, house poor. So I think it's going to have impacts kind of across the board.
Yeah, I agree. So the second one is future rate hikes. Now, we're taping this video on February 24th. So Russia actually just invaded Ukraine, and the stock market just has sold off over the last week with just the fears of this happening. And I've seen some analysis suggesting that those rate hikes that were planned, like they don't even need them at this point. Like the markets have completely cooled and sold off for different reasons. But it sounds like the likelihood of the level of rate hikes that maybe were planned, the thought is that we might not even realize those. And who knows? Maybe we do.
Yeah.
Inflation still runs hot. Maybe they still do that. But if markets have cooled this considerably, the stock markets have sold off the way they have, are they really going to layer in rate hikes on top of that, which would further exasperate that problem? I don't know. It's worth watching. But I think the probability of rates going above 5 at this point with what's going on in the world, I think it's less than it was before a week ago, if that makes sense. I think this news has me thinking that rates will actually stabilize where they are or even potentially trickle back down, but I don't think we're going to get above 5. What are your thoughts on that?
Yeah, I've been going back and forth. They came out first, say we're going to have 4 rate hikes. Oh, everyone panic. And then it was 7. And that seems scary. The one thing on the rate hikes, I tend to believe that the market responds to that news immediately. So some people think, well, the rate's already 4. It's going to be, 6 by the time we get through all these rate hikes. I don't think that's true. I think the market reacts right away to that news. And so we're seeing this increase immediately before the rate hikes technically happen.
Yes.
But over the past couple of years, when we saw them drop rates, we didn't see the interest rate on a mortgage drop that day. You kind of hoped it would, but it doesn't react to that. It reacts prior to and around it, so to speak. So the market's kind of its own beast. So I think that's already happened. And then, yes, to your point, those types of things could kind of contradict what the experts are forecasting, so to speak. So, okay, they thought it was going to be maybe 4% by the end of 2022. Well, 4.25% by February, they missed it already.
Right.
So does that mean we're going to keep going up and it's really going to be 5? I hope not. But is it possible? Sure. So it's, I don't know. And like the Russia stuff, that happening last night, it's interesting from, the mortgage world, those types of uncertainties or crazy, experiences that happen, just like kind of COVID did. Those uncertainties cause waves, crazy waters in the market. And what that does is it drives people to bonds. And that's what controls the interest rates. So today actually would be kind of a positive day in the interest rate world, comparatively than what we've seen. Mortgage-backed securities are actually up today, meaning rates are trending down, which is nice. So if we had, some people that were floating a rate, something like last night happening is like, hey, today may be a good day to lock in a rate because they're actually moving in the right direction today when there's uncertainties out there.
No, that's great. Yeah, I agree with you. I think a lot of that's been priced in. Once the news of rate hikes, the Fed taking rate hikes is announced, mortgage rates responded pretty quickly after that. So I agree with you on that. So the other thing I'm watching is just the volatility in the financial markets. I think from the standpoint of consumer sentiment, meaning when people see the 401k looking healthy and they just made 10% of their money because everything went up over the last 2 years and their cryptocurrency is looking great and all that stuff. I just think that has an impact on sentiment. That has an impact on how wealthy an individual feels when making a decision about trading up, for instance. So I think number 3 is really important to follow with trade up buyers. I don't think first-time home buyers are going to be impacted by that. For one, they have probably lower savings and investment balances anyway. And I think boomers are going to be downsizing regardless, like they're moving out of their dream home. That might even, cause them to move quicker if there's any uncertainty with their investment accounts. So I think they're going to be in the market no matter what. I think first-time home buyers will be no matter what. But it's families like yours and mine that might say, the balance was here, now it's there. How do I feel? How aggressive do I want to be? And ultimately, if you have another kid, you're probably moving. But there's some people in that group of trade up buyers I think we lose, or at least go on the sidelines for a little bit if their investment balances go all over the place. Any thoughts on that when like you're working with your clients?
Yeah. Yeah. I mean, not too specific, I guess, that like maybe have put them on the sideline, but we've had some conversations recently of, when we're talking about down payment, hey, what are we thinking? Do we want to stretch for the 20%? Do we want to hold back and keep some cash, stuff like that? And that's come up plenty of times here in the last couple of weeks of just like, well, my stuff here and there is getting hit pretty hard, so 20% might be tough now, things like that. So it's definitely having an impact. I haven't seen it from a overall purchasing, am I still going to purchase standpoint, but from a down payment, or even like, do I feel comfortable putting the full 20%? It's gonna wipe out a good chunk of my savings, and if that gets hit a little bit more, I'm going to be pretty strapped. So maybe backing it down to 15, 10, even 5%, and just saying, hey, I want to hang on to some of this because of the uncertainties would definitely play a part.
Yeah, it makes sense. So the last one is new construction. So we live west of Chicago, so there's maybe less of an impact here, but there are probably some markets that are actually at risk of oversupply, which is crazy to think about. But apparently, these new developments are popping up very quickly in the South. Texas and Phoenix were mentioned as areas that there actually might be a fear of oversupply because they're building so much so quickly down in those markets. Again, that's foreign to us here in Chicagoland. For one, there's really little place you can go, a little bit west, but there's limited infrastructure there. But we're not seeing that type of activity here, where even though we have a negative migration pattern where we're losing some people out of state, we still have demand greatly exceeding supply because we don't have new build or new construction at the pace that some of the areas in the South have. So it's interesting because those in many ways could become, over the next couple of years, a riskier market to play in, given how quickly home prices have gone up, followed by the new construction activity where we're here, we really don't have supply coming out of thin air. And even if we have interest rates go up, to me, demand is still so much higher than supply. It ironically might be a more resilient place to have a house, if that makes sense, just based on affordability. Yeah, I don't know your thoughts on that, but I know that's kind of an oddball one, but it's something interesting just to see where they're actually building homes.
Yeah, no, that's news to me. You'll have to share that with me, because I haven't heard anything like that. Most of what I've heard is all about, ever since 2008, 2009, the new construction has been down, 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 and it's never recovered. And now prices are so expensive, it still can't recover. And, it's a long, long, long effect of shortage that's going to continue. But that's an interesting insight of not just like maybe as a nation, we'll still be short on new construction, but there's
some
particular
pockets
areas
forming. Yep.
That, they're going to get maybe bit in the butt a little bit by that. It's interesting.
Yeah, man. So what else, is there any final, thoughts on just what would you say to a buyer that's thinking, or ask you the question, is it a good time to buy a house? What would you say?
Well, the old adage of location, 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 just speaking to that point right there, maybe, it depends on where. There's certain spots where buying a home is almost always a good idea, because it is that appreciating asset that guards against inflation, guards against certain things. You have tax write-offs. You have a lot of advantages to it. So obviously, I'm pro purchase. When we do rent versus own comparisons and things like that, I'm kind of on that side of the aisle, I guess. But it depends. We've also run into plenty of people who, hey, we're looking to refinance, and you've just come to a point of like assuming that they've gained so much equity over the last couple of years, because what we've seen in appreciation. But you see some that, I bought in 2014 or whatever, and oh, the home is actually worth less right now than when you purchased it. You
Mm-hmm.
don't see that really around here, but in some of the other areas I've worked in, I've seen that. And so for the most part, I would be on the side of, yeah, it's still a great time to buy. You know, the cards are kind of in the seller's favor at this point because of supply and demand. But if you're buying in a good spot, I believe that we're going to continue to see appreciation in those assets. And with highest levels ever of inflation, that makes it even more beneficial to have some sort of tangible asset like that guards against it.
Nice, man. Well, I appreciate it. We'll have to do this again.
Absolutely.
We can't play golf right now, being it's February, so might as well record some videos for folks.
Yeah.
So,
Actually, to get some work done.
Yeah, exactly. Got to. All right, man. We'll have a great day, and we'll do this again soon. All right.
All right. Sounds good.
All right. See ya.
Thanks.